Today, we're going to break down a tax strategy that can help investors save money. Tax loss harvesting. If you invest in stocks, ETFs, mutual funds, or bonds in a non-registered account, this is something you should know about. Welcome to the channel. My name is Anthony Gismondi. I'm a Senior Wealth Advisor with Aegis Wealth Management, a part of Wellington-Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help them reach their goals. If you're new to the channel, please make sure to subscribe and click the like button. What is tax loss harvesting? Tax loss harvesting is a strategy where you sell an investment at a loss to offset taxable capital gains. This can reduce your overall tax bill. Let's say you sold an investment for a profit earlier in the year. That's a capital gain, and the government wants a cut of it. But if you also have an investment that's lost value, you can sell it to create a capital loss, which helps cancel out some of all that taxable gain. And here's the best part. If you don't have capital gains this year, you can carry your losses back up to 3 years or carry them forward indefinitely to offset future gains. How does tax loss harvesting work? Here's how it works. You sell an investment that's trading below what you originally paid for it. This creates a capital loss. You use that capital loss to offset capital gains, reducing your taxable income. If you don't have any capital gains this year, that's fine. You can apply the loss to gains from the past 3 years or save it for the future indefinitely. Here's an example. Let's say you sold a stock earlier this year and made a $5,000 capital gain. But then you also have an ETF that dropped in value. When you sell that now, you'll realize a $3,000 capital loss. By applying that $3,000 loss to your $5,000 gain, your taxable gain is reduced now to only $2,000. Since only 50% of the capital gains are taxable, you're now taxed on just $1,000 instead of the $2,000, resulting in significant tax savings. Some factors to consider. Tax loss harvesting is powerful, but there are some rules and important factors to keep in mind. Number 1, superficial loss rule, or 30-day rule. The CRA, or Canada Revenue Agency, has a rule to prevent people from abusing tax loss harvesting. It's called the superficial loss rule, and here's what it means. If you sell an investment at a loss and buy it back within 30 days, you cannot claim that capital loss for tax purposes. This rule applies if you, your spouse, a corporation you control or trust you benefit from, repurchases that same security within 30 days. How to avoid the superficial loss rule? Well, instead of buying the same investment, consider purchasing a similar but not identical investment to maintain exposure to that market. For example, if you sold an S&P TSX 60 ETF, instead of rebuying that exact same ETF, you could buy a similar Canadian stock index ETF with slightly different holdings. Number 2, portfolio rebalancing. Tax loss harvesting can also help you rebalance your portfolio. By selling underperforming assets, not only does it reduce your tax, but also allows you to reinvest in better performing investments that align with your long-term strategy. Eligibility, registered versus non-registered accounts. Tax loss harvesting only applies to non-registered accounts. You cannot use capital losses inside your RSP, TFSA, RESP, or any other registered accounts to offset gains in taxable accounts. Year-end deadlines. This is important. If you want to use tax loss harvesting for this year, your trade must settle before December 31st. Since trade settlements typically take 1 to 2 business days, make sure to complete your tax loss trades before the last week of December to avoid missing that important deadline. Here's an example. Let's say you bought an index ETF for $25,000 a few years ago, and now hasn't done that well. It's worth $20,000. That means you have a $5,000 unrealized loss. If you sell the ETF, you can harvest that $5,000 loss and use it to offset capital gains from other investments. Then, instead of staying out of the market, you could reinvest that $20,000 in a comparable ETF that tracks a different index but has similar holdings. This way, you stay invested while still benefiting from the tax savings. Here's a couple of questions we get with the strategy. Question 1, what if I don't have any capital gains this year? No problem. You can carry back those capital losses up to 3 years or carry them forward indefinitely to offset gains in future years. Question 2. Can I claim capital losses from RSP or TFSA? No. As mentioned before, capital gains inside registered accounts like RSPs, TFSAs are tax exempt, so losses in these accounts cannot be used for tax loss harvesting. Question 3. Does tax loss harvesting always make sense? Not necessarily. While it reduces your taxes, you should also consider whether the investment is still worth holding long term, if selling an asset fits within your overall financial plan. Some final thoughts. Tax loss harvesting is a great strategy for investors looking to manage their tax burden and optimize their portfolio. However, it's not a one-size-fits-all approach. Here's what you should do next. Number 1, review your investments accounts and check for any unrealized losses. Number 2, consider whether selling makes sense for your long-term goals. Number 3, be mindful of the superficial loss rule and make sure any new investments follow the CRA guidelines. Number 4, very important, consult with a tax professional to ensure you're making the best decision for your financial situation. Understanding tax loss harvesting can save you a lot of money over time. If you're serious about maximizing your investment returns while keeping more of your hard-earned money, this is a strategy worth exploring. If you found this video helpful, don't forget to like and subscribe for more financial insights. Thanks for watching, and I'll see you in the next video.